Welcome to 15 Minutes of Pharma. My name is Pereira, Cruz, and my partner in these conversations is Manuel Fernandes. Today, we are continuing our If I Were the CEO series with a situation that many pharmaceutical companies eventually face. So, a manufacturing site comes up for sale, the price looks reasonable, the site has a GMP license, and the equipment looks impressive, and there seems to be plenty of available capacity. On paper, it can look like a great opportunity, and yet acquisitions like this often end up destroying capital. Manuel, if you were the CEO looking at the site, what is the first mistake you would try to avoid?
Yeah, Carlos. As strange as it may seem, I would say that the first mistake that I would try to avoid is to confuse the factory with the assets. Because in regulated pharma manufacturing, the real asset is not the building, the clean rooms, or the installed equipment. Um, the real asset is the operating system that turns technical capability into reliable, inspectable, hopefully repeatable cash flow. And that is a much harder thing to evaluate because it includes, technical know-how, quality systems, the regulatory credibility of the asset, maintenance discipline, batch execution, all the quality of documentation, the team, the capability of the team, and the ability to run the site consistently under pressure. So if I were in this position looking to acquire a factory, an asset, I would start there. I would avoid asking, how much capacity is installed, but I would be asking, what operating system am I really buying?
So, Manuel, the temptation is to think if I buy the factory, I am buying the capability as well, right?
Yeah, exactly. And somehow that is perfectly understandable. A factory available for acquisition always looks, simpler from the outside than it really is. Yeah, you see the site, you see the equipment, you see obviously the licenses, you may even see the customers, and it's very tempting to think, well, this is a very attractive shortcut. But in regulated manufacturing, installed capacity is only the starting point. The real question is whether that capacity can be, operated, inspected, released, sold, and repeated reliably and profitably. And that's a very different question.
So let's say that's the first trap. I'll say
Yeah,
confusing installed capacity with real capacity.
indeed.
But when you look at the financials and the numbers may seem well perfectly acceptable, where can they mislead the buyer?
That's a great question, Carlos, and a very important question. And it's very important that we know when in a position like this of looking into a possible acquisition of an asset that the danger is that EBITDA can hide more than it reveals. A site may show positive EBITDA and still be economically fragile. And why that may be so? Because in regulated manufacturing, the visible earnings may be sitting on top of, deferred remediation, underinvestment in utilities, on a validation backlog, GMP fragility. You may have or be confronted with aging equipment, old equipment, an hidden maintenance burden, weak documentation practices, and well, capex that has simply not yet been recognized. So in this position, I would be very, very careful with any earnings number that has not been translated into real earning power, because EBITDA before remediation capex is often not real earning power. It may just be the the accounting shadow of an operating system that has already been underinvested for too long.
Yeah, that's a very good point. So the real question is not simply is the site profitable today? Is it, it's more like what cash flow will still be there after we account for everything that needs to be fixed, right?
That's precisely that, Carlos. Very well placed. Uh, because capacity is not value per se. Cash flow is really value, and in pharma manufacturing, capacity only has value if it is qualified, executable, commercially relevant, and economically sustainable. So a line may look impressive, a facility may look expensive to reproduce, but if it cannot generate reliable cash flow under real GMP and market conditions, its economic value is far lower than its physical appearance suggests. So, when in a situation like this, if I were the CEO, I would always separate four things. The visible asset from the corresponding replacement cost, and the apparent earnings from the actual earning power. Those are not the same, and it is critical that we can really separate each one of these four things.
Um, this brings us to the idea of a margin of safety. So, in this kind of acquisition, is allowed purchase price enough, Manuel?
Well, Carlos, in my view, in pharma, margin of safety cannot be only financial. It has to be mainly operational. And that is, in my view, a very important distinction. Of course, that price matters, obviously. Of course, that you want some room for error. But in regulated manufacturing, your downside is shaped by more than the purchase multiple. So, if I were the CEO, I would think about margin of safety across four different layers.
Four
The
layers?
first layer
Mm-hmm.
would
Okay.
be a regulatory margin of safety, which means what is the inspection history of the site, how robust are the corrective action, preventive action system, what is the the quality of the validation package, how mature is the quality management system, and well, how exposed is the site on data integrity issues, sterility assurance, cleaning validation, or documentation discipline. The second layer of safety margin would be an operational layer. How capable is the team? How dependent is the site on a small number of people? What is the real condition of the the utility system? How strong is maintenance, and how organized is the maintenance function? Where are the true bottlenecks, and well, how much of this knowledge is tacit and fragile? Then a third layer of margin of safety, it's commercially focused. Are there real customers? Are there real contracts? Is there real pricing power, or we have just a narrative of future demand? It's very important. And the fourth and last layer of safety margin is financial. And one thing that we should want is to understand if the acquisition price will absorb any post-closing capex, the working capital needs, eventual delays, and the execution risk. So, Carlos, yes, if I were in this position, a CEO looking into the acquisition of a pharma manufacturing asset, I would say that margin of safety must be operational before it becomes financial.
Okay, so but this is where it becomes difficult because some of the best opportunities do not look attractive at first. So the owner may have, let's say, a succession problem. The seller may be under pressure, or the site may be underused and considered non-core. How do you distinguish a fixable, unattractive business from a genuine structural trap?
Yeah, that's a great question, Carlos, and that is really one of the hardest parts in pharma manufacturing M&As. Because yeah, you are right. Ugly assets do sometimes create the best opportunities, but obviously, not all ugly assets are opportunities. Some are simply, warning labels. It's the market trying to tell us that walk away. This is not something worth worth buying. So I would ask a very basic question: is the problem temporary, understandable, and fixable? If so, okay, maybe we should look deeper into the opportunity. Or is it structural, deep, and capital destructive? If
What are temporary examples, temporary problems, Manuel?
Yeah, temporary problems may include, lack of commercial focus, succession issues, underutilized capacity, poor commercial or strategic positioning in the market, or investment delays that that can still be corrected. But obviously, structural problems are different. For instance, a weak GMP culture, lost technical teams, lost knowledge, obsolete technology, severely degraded quality management systems, economics that no longer work, and customers that were lost for good. And eventually any other capabilities that cannot realistically be rebuilt. And Carlos, that is why, in my view, distress alone is never the thesis. So I would say that for sure distress creates opportunity only when the operating system is fixable and the value path is credible. Otherwise, the discount is not your protection, is the market trying to tell you something.
So that makes due diligence critical. So, but buyers can spend, I think, months studying documents, financial statements, licenses, and contracts without fully understanding how the site actually works. So, where should they be looking to find the real story?
Yeah, it's another great question, Carlos. And my quick answer is on the shop floor, undoubtedly. Of course, that the data room matters, no doubt about that. You need to make sure that the licenses are there. You need the financial statements. You need the contracts to look into the contracts, to understand the organogram. You need to look into the capex history, the inspection records, of utmost importance. But in regulated manufacturing, the truth of the asset is rarely fully visible in the data room. It appears in the plant, in the quality of the batch records, on the maturity of the supervisors, on the way that deviations are investigated, in the lines, how long do you take to set up the lines between different batches. the stoppages, the repeated stoppages that your lines are suffering, the relationship between production and quality assurance, how your maintenance is organized, the level of the of your reactive maintenance, and all the people that hold critical know-how that may not be documented anywhere. So, in this position, I would say this very, very clearly. In pharma manufacturing, some of the most important liabilities are not on the balance sheet. They are hidden in the operating system. And if you do not go to the shop floor to see them, you are not doing real due diligence.
Yeah. So what you're saying is you need boots on the ground. So the documents may be accurate, okay, but they may not tell the whole truth about the operation. Yeah.
Precisely, Carlos.
Mhm.
Because a regulated site um, can look compliant on paper and still be operationally fragile. And that fragility is often what destroys value after closing. And, uh, and, and that is why I think the real due diligence has to move from the data room to the plant. Not to ignore the financials, but to test whether the financial narrative is actually supported by operational reality.
So, Manuel, now imagine you have completed the site visit and the diligence, okay, and the decision is in your desk. Uh, what would a convincing investment thesis look like?
Well, I would want that thesis to fit in two sentences, Carlos. I would want it to be, very crisp and clear. If the acquisition thesis cannot be stated clearly in two sentences, then the buyer is probably, still buying a narrative, not value. So, in my view, a good thesis would sound something like this, along these lines. So, we are acquiring a regulated manufacturing asset below conservative value with preserved technical capability, manageable remediation, and a credible path to convert underused capacity into reliable cash flow through our own commercial and operating advantages. And that, in my view, is a thesis.
A good thesis.
A weak thesis, Carlos, would simply sound something like this. Take sterile injectables, for instance. So, sterile injectables are in demand, and this site looks cheap. So, let's go for it. Let's go and buy it. So, this is not a thesis. This is hope. This is wishful thinking. Um, I would really insist on clarity because, disciplined capital allocation really starts with disciplined language.
Okay, so for you, clarity is part of the discipline. So to close, what is the one question you would want a CAO to remember before buying a manufacturing site?
That's a great question, and I think the very good way to wrap the episode, to wrap up
Mm,
this episode. So, I would not ask first whether the site is available. I would ask whether the operating system is understandable, trustworthy, and capable of becoming cash flow. Because, as we have said in the beginning of the episode, the factory is not the asset. The asset is the regulated operating system behind it. And in pharma manufacturing M&A, the quality of judgment, in my view, lies precisely there, not in buying capacity, but in knowing whether capacity can truly become value.
so whether capacity can truly become value. Okay, so I think that's the point to remember. A factory may be visible, but the real asset is the operating system behind it. So, Manuel, thank you. And thank you all for listening to 15 Minutes of Pharma. So, in this episode of If I Were the CEO, we looked at why buyers can destroy value when they confuse installed capacity with a manufacturing capability that is reliable, compliant, and economically sustainable. See you in the next episode. Bye, Manuel.
Bye, Carlos. Thank you, and thank you all for listening to us.